Let's move on right now. We're going to do that as we look at foreign exchange, the dollar. We can look at international economics, what Nathan Sheets said yesterday of a global slowdown. We do that with William Lee, Chief Economist at Milken Institute. Billy, thank you so much. Are you as gloomy as your good friend Nathan Sheets? Can you give me a global GDP of sub 3% for next year?
It'll be even more of a sub 3% if China doesn't get its act together. And given what's happening in China now, it looks like it's not going to happen. So Nathan is a little optimistic because I think he's not revised down China enough, perhaps because of political reasons.
What did you learn from the Congress of President Xi? Of course, the emotion we saw in that video, I believe it was just a week ago. But Bill Lee, what did you learn? And particularly, what did you learn about Xi in Hong Kong?
I think every Western investor is going to have to reassess political risk right now because China's focus is going to be to turn inward. They're going to say, we care about safety. We care about the threats to our country. We have to worry that the world is gathering around us. And so instead of having policies that strengthen growth and bring back growth and productivity, they're going to be looking at national security, national safety. That diversion, I think, is going to mean a lot for Western investors because anybody who goes into China now has got to tell the Chinese government that we will help you make your companies national champions. And unless we are doing that, we're not welcome.
Bill, you slipped it in there. Wasn't lost on us. Do you think the South side refuses to downgrade China sufficiently for political reasons?
Well, John, we've been here before, and I think I've gotten some feedback from my friends that have guns to my head now. But I think that there's a lot of pressure for companies who are in China, well-established companies like Citi, like JP Morgan, as financials, who need to have a presence because that's the nature of their global business. And if they start getting too pessimistic about China, I think one of the things that's going to happen is that they're going to start getting cut out. And in order to keep their business models going, they have to be cheerleaders for the administration, no matter what they're doing.
How long will China remain an opportunity, though, for some of the multinationals? How long can they continue to basically play by the rules as put out there by the Party Congress when the Party Congress just basically said, we're not sure if we want you?
Lisa, the companies that are there will stay there. But the real question is, where's the marginal dollar going? Where's the marginal investment going? And I think, given what's happening in China, at least for the next several years until the dust settles and we get a clear direction for where deal circulation goes, the marginal dollar is going to be going to ASEAN and Korea, because those are the opportunities, those are the growth zones. Because China has diverted away from the companies that really have given them the growth over the last several decades, the high-tech, highly innovative private sector companies. Xi Jinping has made it very clear, going forward, we're going to be emphasizing growing our national champions and state-owned enterprises. Well, that is almost an oxymoron to say highly productive state-owned enterprises. So the marginal dollar, the smart marginal dollar, is going toward ASEAN and Korea.
Bill, in the past 5 days since the Party Congress had ended, we've seen a 9% decline in Chinese stocks traded in Hong Kong. It is a record decline in the equity markets following this meeting. How much do you take a signal from this that's lasting, where foreign money will not be welcome in China, it will not return, and there will be a very different look with a much slower growth profile for a longer period of time in China?
Well, Lisa, not only have valuations gone down, but the actual number of dollars is coming out. And I think that says a lot about both supply and demand. The Chinese have said, you're not welcome unless you're helping us develop national champions. And quite frankly, the desire to be in that huge market has gone down because Xi Jinping has made it very clear, this huge market is for Chinese companies. If you're going to help us develop the Chinese market for Chinese companies, come on in. But if you're not going to be doing that, if you're going to be doing what you've been doing for the last 100 years, exploiting us, stay out. And that's a very clear message.
Billy, I was thunderstruck at the meetings in Washington that you used to live and breathe, at how people weren't talking about Fed talk and central bank chatter. They were talking about dollar liquidity and swap lines. As we go into this weekend, give us the Bill Lee swap line update. Is it something to worry about?
Keep an eye on what QT does to bank liquidity around the world. That's where we're going to see the drying up of liquidity, because I don't think the Fed has really realized that it has to really have strong repo markets and non-bank markets in order to facilitate the withdrawal of liquidity from the banking system. And once that happens here in the United States, it'll have global implications around the world, because liquidity not only will dry up here, it'll dry up way around the world.
Does that fold over to a more accommodative monetary policy? Does the balance sheet and repo challenge become a discussion at the Fed press conference November 2nd?
Tom, bite your tongue, because the one thing the Fed cannot afford to have anyone say is they're not credible. And any kind of inflection point now, before inflation turns around, is going to destroy that hard-won credibility post.
Yeah, but Bill, we have a hard-won credibility with a balance sheet that William McChesney Martin never envisioned. The two, and John Farrow's been great at this, the two have to dovetail together. What do you predict over the next 3-4 Fed meetings is they dovetail balance sheet dynamics with some form of monetary theory?
John has been very spot on to say, keep an eye on the Fed and ECB, because the place they're going to blink is not so much in the rate and the speed by which they raise rates. It's going to be how they do QT. ECB has a huge aversion to anything starting with Q. So we know they're going to be QE forever. But the Fed may actually start to blink, because if financial stability starts to rear its head and we have volatility in the repo markets and non-bank markets, that's where you're going to see some easing. And that will be caught by markets, and we will start to lose the credibility, and inflation expectations will start to take off again.
Hey, Bill, wonderful. As always, Bill Lee there of the Milken Institute. We're looking at the ECB, not just the Fed. I'm impressed with this morning. It took us about 38 minutes before we discussed the Fed, Tom. And it was you, not me or Lisa.
Did I do okay?
So there we go.
No,
CPI.
He said you're spot on. And Bill Lee never says I'm spot on. It's always
He told you to bite your tongue.
I know. He did.
Can you do that for 10
I'm in
seconds?
Bill Lee time. I'm trying.
Just as I go through the CPI data out of Italy. 12.8